If you had invested $10,000 in a growth ETF 10 years ago, you could have ended up today with $50,000, $70,000, or even $170,000, depending on which part of the growth market you had invested in. That's why today I want to give you an overview of all the options you have within the growth market, because growth is not just growth. We'll see the difference between tech-heavy growth funds like QQQM or VGT, factor-based growth ETFs like SPMO or SCHG, and sector-based growth ETFs like SMH or IBP. By the end, you'll be an expert on the growth market and you'll know exactly which type of growth ETFs make sense for you. My name is Rick, your favorite Italian investor and twin of Mano Ginobili, and if you don't know me, you can subscribe, check out my channel, and well, either you're going to find lots of interesting content about investing, or you can talk bad about me in the comments. But now, let's start with the video giving you an overview of the different types of growth ETFs. Alright, so before we start throwing ticker symbols and factor investing and other stuff, let's quickly answer the obvious question. What exactly is a growth ETF? Well, a growth ETF is basically a basket of companies that are obsessed with growing. They focus on growing the business and therefore they reinvest most of their earnings every year to innovate. The result is that usually they show low profit in a financial statement, and for the same reason, they usually don't pay high dividends because they prefer to use as much money as possible for their expansion. Now, compare that with value stocks like Coca-Cola, Johnson & Johnson, PepsiCo. Those are the companies that already made it. They don't have much space for improvement, so they live on what they already created, cash the earnings and distribute it to the shareholders. The interesting thing is that not all growth ETFs are created equal. In fact, they come in three main flavors. Number one, tech-heavy, broad-based growth ETFs like QQQM and VGT, where you're essentially betting on big tech continuing to dominate. Factor-based growth ETFs like SCHG and SPMO, which use rules and data to systematically pick the companies with the strongest growth or momentum, and sector-based growth ETFs like semiconductors, SOXX or SMH, or biotech, IBB, XBI, where you're zooming in on one high-growth corner of the market. Each of these could take your portfolio to the moon or flush it down the toilet. So let's break it down, starting from the broad tech-heavy growth ETFs. Now, the big advantage of such ETFs is they give you instant access to the world's great tech companies all in one simple basket, without the risk of focusing on one single part of the growth market that might lose momentum or performance in the future. They are obviously also better than risking picking stocks, because I know it's always easy to recognize the power of companies like Tesla, Apple, or Nvidia after they've grown so much. But the mistake most people make is to jump on too late, when the big growth has already happened. Buying broad growth ETFs is like betting that the future of the world will be dominated by tech, without taking any risk on which tech, which company, or which sector will win. So, let's meet our stars. ETF number 1, QQQM or QQQM, the Invesco Nasdaq 100 ETF. This is the little twin brother of QQQ, the biggest growth ETF in the world per assets under management. QQQM tracks the Nasdaq 100 index, which includes the 100 largest non-financial companies on the Nasdaq Stock Exchange, which is a stock exchange that is based on technology and growth. And the ETF has 106 holdings with over 60 billion in assets under management, and as you can see from the sector allocation, you don't need to focus on technology to have growth. In fact, half of the ETF is distributed within growth companies from consumer discretionary, communication services, staples, industrials, healthcare, and all other sectors. Obviously, a big chunk of the ETF covers tech companies like Nvidia, Microsoft, Apple, Broadcom, but also communication companies like Meta, consumer discretionary like Tesla, and consumer staples like Costco. Second ETF, VGT, the Vanguard Information Technology ETF. If you're looking for an ETF that contains all tech from small, mid to large cap markets and only tech, VGT is your guy. 316 companies, an incredible earnings growth rate of 32%, and a brutal return of equity of 40% almost justify a PE ratio of 39x, which in my opinion is still way too high. And well, in case you don't know, PE ratio is the price to earnings ratio, and the higher it is, the higher the price is compared to the real earnings of the companies inside it. Third ETF, XLK. XLK tracks the Technology Select Sector Index, including tech companies from the S&P 500 index, so it's basically like VGT, but with only large cap companies. XLK is one of the 11 select sector ETFs from State Street Global Advisors. So basically, SPDR divides the 500 companies of the S&P 500 into 11 sectors and offers an ETF for each one of them. We have communication services with XLC, consumer discretionary with XLY, consumer staples with XLP, and so on, and one of them is technology with XLK. Let's take a look at the returns now. In the past 5 years, tech was the strongest sector, and in particular, XLK had a higher return than even VGT, showing that large companies now are getting a bigger and bigger chunk of the market. By the way, I'm using QQQ here instead of QQQM, just because QQQ is older and we have more data, and because they are identical anyway. And also included the S&P 500 with SPY, which as you can see, underperformed the growth ETFs. Looking at the last 10 years, tech kept dominating, but you notice that VGT now was the best performer, meaning large cap wasn't always the best performer. If we take the longest time frame possible, namely from the first moment that all these ETFs were coexisting, you notice that in the past 20 years, no matter what you chose, if just the growth sector or specifically tech, the result would have been extremely better than investing in the S&P 500. And look, this time QQQ is the winner, even though tech got better in the past 10 years. To summarize, broad-based growth ETFs give you the widest tech exposure with relatively low cost compared to the specialized ETFs we'll see later. Another interesting type of growth ETF are the so-called factor-based growth ETFs. A factor is basically a recipe that the ETF follows. Instead of just saying, give me all tech companies, it says, give me all tech companies that are performing better relative to this particular factor. For example, companies that are growing earnings the fastest, or with the strongest momentum, or even with the cheapest stocks relative to their fundamentals. The main factors we know are value, so cheap stocks, growth, so fast-growing companies, momentum, so stocks on a hot streak, quality, so profitable, stable companies, size, small versus large caps, and low volatility, stocks that move less than the market. Now, in the growth ETF world, there are two examples that stand out, and we're going to talk about them today. One is SCHG, the Schwab US Large Cap Growth ETF. SCHG is a great alternative to QQQ or VGT, and it's a broad, cheap, diversified, and super easy to hold long-term ETF. It tracks the Dow Jones US Large Cap Growth Total Stock Market Index, which is constructed based on the growth factor. So basically, what SCHG does, or better said, the index that SCHG tracks, is to select companies that exhibit strong growth characteristics. This can be measured with financial metrics such as high earnings growth, high sales to revenue growth, and high book to price ratios compared to value stocks. Essentially, SCHG is a factor ETF because it systematically screens for companies that have the growth factor, instead of picking all growth stocks like VGT or XLK do. The second ETF is SPMO, the Invesco S&P 500 Momentum ETF. This one is kind of cool because it rebalances every quarter and tries to chase the stocks with the strongest momentum. Momentum is basically the idea that stocks that have been going up recently are likely to keep going up, at least in the short term. So SPMO buys the stocks with the strongest recent performance and sells the weaker ones. By the way, I've made a whole video about SPMO, and you can check it here, or even better, at the end of the video from the link that I'll write in the description below. The interesting thing about factor-based growth ETFs is that they let you engineer the type of growth exposure that you want. Maybe you're a strong believer in momentum, and you'd rather have a momentum ETF than an ETF that picks all tech ETFs and weights them just based on market cap. The flip side is they can look great 1 year and absolutely dreadful the next. So factors are extremely powerful, but always be careful with them. Alright, the next step are the sector-based growth ETFs. These are growth ETFs that are based on a specific sector. For example, semiconductors, AI, or biotech. This is the kind of ETFs that you invest in if you want to bet on a particular part of the market, hoping it will perform 10 times better than the rest and make you rich. There is one thing I need to tell you. Usually, when people invest in these sectors, it's too late. For example, Semiconductors. The semiconductor sector has grown immensely because of the deployment of AI. And don't get me wrong, semiconductors have a great future. The thing is that right now, there is a lot of expectation priced into future earnings of the sector, and we are at the peak of the stock market optimism. So whatever blockade, whatever slowdown we might see in the near future is going to be particularly hard on this sector. This means that yes, semiconductors and AI are great sectors, but this doesn't mean that you can lose money. Anyway, let me give you 3 examples of strong ETFs that are sector-based. Number 1, the semiconductors ETF everybody should know, SMH, the VanEck Semiconductor ETF. This ETF is one of the things that if you could foresee them 10 years ago, you'd be rich now. In fact, SMH delivered an average of 29.31% per year in the past 10 years. Just to give you an idea of what it means. If you invested $10,000 today and then you stopped investing and this $10,000 were to grow at 29.3% per year, after 30 years, they would be turned into $54 million. Second ETF, AIQ, the Global X Artificial Intelligence and Technology ETF. Considering that now AI is everywhere, this ETF lets you invest directly in the companies building the future of artificial intelligence. I'm gonna cut it short here. AI is great, but I never suggest people investing in a specific AI ETF. Usually, such specific ETFs are mostly driven by emotions, so they tend to become overpriced quickly, riding the wave of optimism. Anyway, I'm not a financial advisor, so you shouldn't listen to me anyway. Third ETF is IBB, the iShares Biotechnology ETF. Biotech is another interesting sector which has a lot of potential and a lot of risk. One FDA approval can send a stock to the moon. One failed trial can crash it back down. So, why choose a sector-based ETF? Honestly, I'm not a fan of specific growth ETFs like these, but some people like them because they represent particular things that they believe in, and they might get flashed by the idea of making 30% per year and becoming a millionaire soon, which, by the way, almost never happens. So, if I were to summarize this whole video in one sentence, my suggestion for growth investors is to invest in broad-based growth ETFs like QQQ and VGT, avoiding specific sectors only because they shined in the past 10 years. But of course, every investor is different, so let's figure out what fits your style. If you believe tech will keep dominating the world and you want to ride the big names like Apple, Microsoft, and Nvidia all in one basket, QQQM or QQQM or VGT might be your play. If you want a more systematic, balanced approach where you follow rules and data instead of just betting on sectors, factor ETFs like SCHG or SPMO make sense. If you instead love the thrill and want to double down on specific industries, sector-based ETFs like SMH or AIQ let you bet on semiconductors or AI. High risk, high reward, or high loss. Remember, there is no solution for everybody. So you need to decide for yourself. So basically, pick what matches your goals, risk tolerance, and how much drama you can actually handle in your portfolio. But if you pick something and then a big crash swipes away all your retirement savings, well, don't say I didn't tell you. Alright everyone, if you enjoyed this video, subscribe to the channel to support me and get more videos like this. Thank you by the way for this. And if you want to hear something more on the Momentum ETF SPMO, you can watch this video. Instead, you can watch this video if you want to know how to create the perfect ETF portfolio. Apart from this, thank you so much for watching. I wish you a great day or evening. And as always, I'll see you in the next video. Ciao.